Okay, so moving on, let's talk about the allowance method for accounting for bad debts. Now let me first say this is the GAAP approved method. GAAP does like you to account for your allowances, your bad debts using this allowance for doubtful accounts, which is what we're going to be talking about. Now let's set this up to begin with. Hang on just a second. All right, what I've done is I've already set up the T accounts here for accounts receivable and allowance for doubtful accounts. I want to give you like an overview of how this works first before we get into the actual journal entries. All right, starting off with accounts receivable. Let's say you and your business have $100,000 in your accounts receivable balance, in your accounts receivable accounts. All right. Now you know well and good you're not going to collect $100,000. You're going to collect something less than $100,000. Let's say, for argument's sake, and we're going to do the calculations in a little while, but let's say for argument's sake, you know that approximately $5,000 worth of these receivables are going to be defaulted upon, which means they're not going to pay you. So when you have this, what GAAP wants you to do is they want you to have this account called the Allowance for Doubtful Accounts. And they want you to offset your receivables by the $5,000 that you think you're not going to get paid. These accounts together, ready for this, are called Contra Accounts. Okay? This account to this account. They're Contra Accounts, which means they have offsetting balances with one another. Accounts receivables as an asset would carry a debit balance, and your allowance for doubtful accounts carries a credit balance. These two accounts are looked at together when you put them on the balance sheet. And what happens when you put them together is you net them, and your net receivable amount is then $95,000. Okay, and this makes sense because the whole idea here is that what GAAP wants to see is they want to see what are the actual receivables you expect to collect. Okay, you may very well have $100,000 worth of receivables, but if you really don't think you're going to collect 5 of them, then in actuality your asset is worth $95,000. So on the balance sheet you would see accounts receivable of $100,000 less the allowance for doubtful accounts of $5,000, and the net amount would be shown of $95,000. Your asset of receivables would only be shown at the $95,000. Okay, so now that you have a grand overview on how this works, let's get into the allowance method a little bit here. I'm going to leave that here for now just in case I decide to use it later. Okay, so with the allowance method, there are 2 different ways you can calculate what amount you're going to use in this allowance for doubtful accounts. The first method we're going to use is called the income statement method. And I don't think I have enough room for method. Well, good enough. Okay. The first thing I'm going to use is called the income statement method here. Oh, doesn't let me underline. Okay. And with the income statement method, what you do is you look at your amount of sales. Let's just say you happen to have $1 million in sales this year. Okay, so let's put $1 million in sales. You have $1 million in sales this year. And you know, traditionally, based on the fact that you've been running this business for so many years and so on and so forth, you know traditionally maybe 3% of people don't pay you. Okay? So what you're going to do is you're going to multiply $1 million times 3%, which is your estimate of how many people are not going to pay you, and you are going to come up with an allowance for doubtful accounts number of $30,000. Oops. This is what you're expecting to not get paid. Okay, so I know that sounds a little bit weird, but that's how it works. All right, so if you really want to think about it, let's say you had accounts receivables and your sales was the same amount, $1 million. Oh, I guess maybe I should kill the commas here to make this fit. Okay, and your allowance for doubtful accounts, you're going to set it up to be $30,000. So your net realizable value of your receivables, if all of those sales were receivables, is $970,000. Okay, and that's how they would work together. Now let's see how the journal entries work for this. The journal entries work for this by first recording that full $30,000. Remember, this is just an estimate of the people that we think are going to default. Default estimate. All right, this is our best estimate as to what people are going to default. So when we actually do the journal entries, we go straight to this allowance for doubtful accounts and to this bad debt expense. We debit our bad debt expense for $30,000, and we credit this allowance for doubtful accounts. I'm cheating here and writing it shorter so I don't run out of room, of $30,000, and that is reflected right here. Here's that credit to the allowance for doubtful accounts. Okay, so we almost are setting aside money in a bucket, if you will, for people to default with, and that's what this allowance for doubtful accounts is. All right, let me get rid of this for now. Okay. Now let's see what happens when people actually start defaulting. This first part is just the setup for the allowance for doubtful accounts and the bad debt expense. Now remember, we recorded all the expense even though nobody has defaulted yet. So now let's see what happens when people start to default. All right, let's say little Tommy again owes us, we'll say $1,000. Little Tommy owes us $1,000 and he's going to default on his debt. Well, it's not going to be a debit to bad debt expense the same way it was for the direct write-off method, because we already captured our bad debt expense right here. So what we're going to do every time somebody defaults is start to use up our allowance for doubtful accounts. So let's say Tommy defaults for $1,000, and we've got accounts receivable, Tommy, $1,000 that we're taking off the books. So if we continue keeping our T accounts here, here's our accounts receivable for Tommy, and here's where it shows that we're using up our allowance for doubtful accounts. Okay? Now let's just say somebody else defaults. We'll throw another person in there. Let's say Susie defaults, and she owes us $3,000. Okay, there's our allowance for doubtful accounts, $3,000. Oh, I should have put that there. And accounts receivable, Susie. I'm just putting the names there to keep this straight, of $1,000. Oh, not $1,000, $3,000. Okay. And that's how you're writing off people who are not paying you and are defaulting. Now let me say one thing about when people default. I don't know if I mentioned this in the previous section, but the idea is that there's no real rule about when you record people defaulting. It is when you, as a business, have decided people are going to default. Maybe you saw that little Tommy had filed for bankruptcy and you assumed you weren't going to get paid, you were $1,000. So with that, you wrote his receivable off, never expecting to collect it. Or what if Susie called us and said, I'm suing you because I hated your donuts so much and they made me sick? All right, that would probably be an indication that it might be a good idea that she's not going to pay you. It could be any number of things. It could be that once receivables hit, 200 days old, that you write them off. It's going to be your decision as a business at what point you write these receivables off. Okay, so now what happens if, before I'd said Tommy, let's say Tommy had filed for bankruptcy, so you never expected to get paid. Now what happens if Tommy, lo and behold, does pay you, all right? You receive money that you didn't expect to get. Oh, let me fill in Susie here. Here's our $3,000, the reduction of receivable, and the using up of the allowance. Okay. Let me get back to this. Now let's pretend Tommy does pay us. Well, wow, wonderful, things are great. We got a check in the mail that was completely unexpected. Okay, so what we do is we basically have to reverse what has already happened here. Let me start over here. We have to reverse our write-off. So we have to put the receivable back on the books. Tommy. Wow, okay, $1,000. And put the money back in the allowance, because we don't need it anymore. We got paid. Okay, so what we've done here is we've reversed these entries. That's not going to be good. Oh, I lost my line. Okay, but what I've done here is this entry reverses this entry. It makes it as if it never happened. Alright, so following through, keeping my T accounts going here, I put the receivable back on the books, and I put the allowance back because I'm not using it anymore. Alright, so now that Tommy has paid us, basically this entry has almost, I hate to do it this way, but it's almost as if this entry has now negated this entry. It's almost as if they didn't happen now. So basically what it stands as is we've got a receivable from Tommy. Okay, so to follow it through, let's say this wipes this out. I mean, all these entries are still there. It's just a matter of I'm just showing you guys that they're wiping themselves out. So basically we have this receivable from Tommy now that he paid. Just simple. Don't even worry about the bad debt aspect of it. That all of that is gone. So we get Tommy's cash. Yay, here's our $1,000. And then we take his receivable off the books because he paid us. Okay. And that is how we do. Well, that didn't work out quite right, but you get the idea. Accounts receivable Tommy goes over here. There's my $1,000. Okay. So what happens here is we have now just done the income statement method. We took a percentage of sales and we used that $30,000 to estimate our allowance for doubtful accounts. And then we had several transactions on it. Okay, I'll continue with the balance sheet method in the next section.